Sometimes a fund manager captures the mood of a market, and in 2020 that was clearly Cathie Wood with her suite of ARK funds, which invested in tech companies which were very disruptive and innovative. But then in 2021 the magic seemed to go away and she started underperforming. So in this video we're going to look at the reasons behind that turnaround, but also whether she can pick it up in 2022 and beyond. Also, now in the UK, it's possible for people to invest in her funds, although it is rather expensive, as we'll see. So let's look at Cathie Wood's ARK funds in a bit more detail. This graph tracks the value of $100 invested in 5 of her funds at the beginning of 2020. Now, initially there was a bit of a dip because the entire market sold off, but following that, the returns on her funds were simply spectacular. But then in February of 2021, you can see that the returns started to turn around. And since that peak, there really hasn't been much of a recovery for her funds. This graph looks at the same time period, but it compares return with an S&P tracker, SPY, and with the NASDAQ tracker, QQQ. Now over that period, she's beaten those other 2 funds, but now she's neck and neck with the NASDAQ. Now the reason why her fund has turned around in terms of outperformance is because of the popularity of the stocks which she's bought. So in this graph we're looking at how much each of those stocks has fallen since its peak in 2021. Now what's truly remarkable is how many of them have fallen very dramatically over the course of this year. 5 of them hadn't fallen by more than 20%, but the rest of the stocks had. And if you look at the bottom of this graph, you can see that many of the stocks in ARKK have had catastrophic falls. For example, Robinhood has fallen by over 70% since its peak. Now, when I tweeted that graph, it was picked up by the FT and it was actually published in one of their articles, which was called ARK's Cathie Wood, Queen of the Bull Market Faces Her Toughest Test. If you look at the amount of money which ARK Invest is managing, you can see that their assets under management ballooned during that huge rally. And that's typical of many active funds. When they outperform, they draw in lots of capital. But her growth was really something else. So she increased the size of her assets under management probably tenfold over the course of a year. But then as soon as the outperformance ended, you can see that the outflows started and she's gone from a peak of about 60 billion in assets under management to around half of that at the end of the year. Now, part of the turnaround has been a change in market sentiment. So for example, Goldman Sachs creates this index of non-profitable tech companies. And just like Cathie Wood's funds, those saw an incredible run in 2020 and turned around at almost exactly the same time as Cathie's funds in February of 2021. So it seems like the market appetite for these kind of companies which offer huge results in future but offer very little in profits today has simply diminished. But that's not because growth stocks are performing poorly. If you look at the Russell 3000 Growth Index, which is here in blue, you can see that that's actually still been powering ahead, while ARKK, the disruptive innovation ETF, has been floundering. So growth stocks remain popular. It's just not Cathie's flavour of growth, which is popular. So given that February was the turnaround point, what was the trigger that happened then? In this graph, we're looking at when each of the stocks in her fund peaked. So for example, Tesla peaked at the end of the year, whereas this huge cluster of stocks in her fund peaked at the beginning of the year, just before that turnaround. And on the y-axis of this graph, you can see how much they've fallen since that peak. So for example, these in the bottom left have fallen by around 70 or more %, whereas this group, which have peaked quite recently, such as Tesla, have sold off far less. Now, investor willingness to take risk depends very much on interest rates on risk-free assets, such as government bonds. Now, when interest rates are very low, close to their zero lower bound, as they have been for much of 2020, people are willing to take huge gambles with growth stocks. But when interest rates are about to rise, suddenly that risk appetite starts to dissipate. So this dashed red line on this graph shows you the turnaround for Cathie Wood's funds. The line at the bottom is the 1-year rate on US Treasuries, the middle line is the 10-year rate, and the top red line is the 20-year rate. So notice how at the beginning of the crisis in 2020, yields dropped pretty much to zero. That's when Cathie's funds really started to rally. Then towards the middle of 2020, yields started to gradually rise, but that was mostly at the long end of the curve. The short end was still falling. But then in February, what seemed to happen was that the yield started to accelerate upwards. There was a very sharp spike upwards in yield at the long end of the curve. Plus at that point, the Federal Reserve started to talking about tapering. That's a reduction in their rate of asset purchases. And as a result, a lot of that huge risk appetite started to diminish. It's kind of like when your parents say they're about to arrive back home and suddenly you have to tidy up the house. With the prospect of rates suddenly increasing, those crazy growth stocks suddenly look much less attractive. Or as Warren Buffett puts it, when the tide goes out, you can see who's swimming naked. Now, if you want to keep up to date with topics like ARK, but also what's happening in economics and how it affects markets, why not sign up to our free weekly market roundup? You can see the story about Buzzkill, which mentioned ARK here. And if you want to learn more about that, click on the link at the top of this page, but also in the description below this video. So what kinds of stocks were the ones which turned around at roughly the same time as Cathie Wood? This bar plot shows you the returns for the primary factor funds in the US since Cathie Wood's funds peaked in February. Now you can see that the S&P 500 Growth Fund, which is large cap growth, has actually done very well. That's up by 23%. But if you look at the bottom of the graph, you can see the two funds which have done badly are small cap funds, that's the Russell 2000 ETF, and the worst performance has been a combination of small caps and growth. If we plot those two extremes together, so that's large cap growth via IVW in blue versus small cap growth, which is IWO, notice how that turnaround point for Cathie coincided with the turnaround point for small cap growth. And if you actually look at the correlation of ARKK with all of these factor funds, the one which has the highest correlation is small cap growth. Why did small cap growth turn around? Well, remember, these are stocks which have a lot of domestic exposure. Small caps tend to be more domestic in nature. So if growth was to disappoint, that would be bad for these stocks. And a lot of the optimism about the surge in growth following the pandemic had pretty much ebbed by this point. And as we've said, small cap growth tends to be very sensitive to interest rates, which was surging at this point. But given that small cap growth is suffering, why are broad indices like the NASDAQ performing okay? Well, the fact is, most of them aren't doing okay. If we look at how much they've fallen since their peak at the beginning of this year, you can see that many of them have suffered a fall of more than 50% since their 2021 peak. The colours on this graph indicate which companies have been profitable in 2021. Blue is the profitable companies and red is the loss-making companies. And Cathie Wood's choices in ARKK are shown as bigger dots. Now the x-axis here is market cap, so big stocks are on the right and small caps are on the left. So her largest capitalization holding is Tesla. And in fact, that's the stock which has performed best in her portfolio for this year. Now this is a log scale for market cap, so you can see many of her companies have less than 10 billion in market capitalization. So in US terms, they're pretty small. If you look at the percentage of stocks down from their 2021 peaks and track that through time, the white line shows you the percentage which are down 20% and the red line those which are down 50%. Currently that's been rising quite sharply for the NASDAQ. So how come the broad index isn't selling off? Well, the returns for the NASDAQ index have been about 30% so far in 2021. And if we look at the contribution to that 30% from the stocks inside the NASDAQ 100, you can see that on the far right-hand column of this graph from Koifin. The fact is that the mega caps like Microsoft have basically kept the index afloat. That's true of the S&P as well as the NASDAQ. So Microsoft has an 11% weight in the index. Its one-year return has been 60%, and that's contributed over 5% to that 30% return. Similarly, Apple has given about 5% contribution, Nvidia 3%, with an incredible return of over 100%, despite its small weight in the index of around 5%, and so on down this list. The most disappointing of the mega caps has been Amazon. But if we add up those contributions down to Amazon, you can see that they make up almost all of the return for this year. In fact, you could almost ignore all the other stocks in the NASDAQ 100. So I think this is one of the justifications for holding a broad diversified index, which is that you're much less sensitive to a shift in risk appetite, as you would be for a very concentrated fund like Cathie Wood's ARK fund. So given the pummeling that she's received in markets, can Cathie turn it around? And I think the answer is yes. I think she can turn it around. If you look at the performance of her funds leading into the Pandemania rally, you can see that they're very good. She did outperform the NASDAQ. She also outperformed the S&P by a huge margin. So she clearly has a skill at selecting stocks which outperform. We won't get the kind of crazy outperformance that we saw in 2020, but we'll still probably see outperformance for her stock selections, with some provisos that we'll see in a minute. If we look at the quarterly outperformance of ARKK versus NASDAQ, you can see that in some quarters she outperformed, in others she didn't. So over this period of about 5 years, there are 21 quarters, she outperformed in 13 of those quarters, which is pretty good. But in order to outperform in future, I think it'll take these 5 factors which will determine her success. And the first one is still very much in place, and that's risk appetite. We've seen that when markets fall, investors are buying the dip. People still want to take risk, and the stocks she chooses very much require a healthy risk appetite. For growth stocks, interest rates are also very important. Now, of course, rates remain low, but they are gradually increasing and sometimes sharply increasing, and that's definitely going to be a headwind for Cathie. Small cap growth stocks typically require credit spreads to be tightening, and that's because if they have to borrow in capital markets, it becomes cheaper for them to do so. But in fact, what we've seen recently is that it's becoming more expensive for small, low credit quality companies to borrow. So that'll also be a headwind, I think, in 2022 and beyond. Now, inflation rising is strangely often good for small caps. They often outperform because they're the kind of companies that can pass on increases in costs to their customers. But if we do see inflation start to fall again in 2022, as many people expect, that'll be a headwind again. I think the big question mark is whether we're going to continue to see strong economic growth in 2022. Remember, before the pandemic hit, people were talking about secular stagnation. Growth was gradually slowing down and there were very few catalysts to growth. And I think that'll be a big determinant of how well she fares in the future. Now, people often ask me, if they're UK based, in the comments of these videos about ARK, can I buy ARK in the UK? Well, now you can. These funds are issued by leverage shares and essentially they just track ARK funds in the US. Now, what I don't like about ARK funds is their very high fee, which is 0.75%. But in order to buy this tracker, you'll pay an additional 0.15% on top of that. So the all-in fee will be about 1%. Now, they've cherry-picked the most popular funds of Cathie's, so you can buy ARKK, the main innovation fund, but also ARKW, which is the next-gen internet fund, but also ARKG, which is the genomic revolution multi-sector ETF. You can also buy 3 times leverage version of the funds, which I'd probably tell you not to do, because you really don't need to make a volatile fund 3 times more volatile. But if you are interested, there's a 3 times long and 3 times short version of those funds. So in summary then, yes, I do think Cathie Wood can turn it around. It will require those 5 macroeconomic factors to turn in her favour, but I don't think she's going to repeat the returns that we saw in 2020. That was a very special set of circumstances. Now, if I had to buy an active fund that was like Cathie's, I'd probably go for Scottish Mortgage because the fee is lower and also the governance is better. And, if I had to buy it, then I'd usually do it after a market crash, and that's why it's in my market crash shopping list. So if you do think that she's going to outperform, at least now you can buy her funds in the UK. And as always, thank you for listening.